Hi there. Thanks for joining me here for this video on tax-deductible contributions. What we're going to be focusing on this video is providing, or at least understanding, how much of a benefit it could be to take advantage of pre-tax contributions like 401ks or 403bs. And so we can use these as vehicles to save for retirement while also reducing our taxable income and thus how much taxes that we pay on an annual basis. So I shouldn't be spoiling anything by telling you that there are quite a few taxes that are taken out of your biweekly or monthly payroll checks. And so to kind of perform this analysis, we're going to keep things pretty simple, and I'm just going to provide the federal monthly tax liability. Obviously, there are a lot more or many more things that are deducted from your paychecks, like Medicare, Social Security, any optional deductions that you have, whether it's maybe health insurance or life insurance or things of that nature. But we're just going to calculate the federal monthly tax liability to kind of convey how using pre-tax contributions can be of value. And so when I say tax-deductible contributions or pre-tax contributions, what we're talking about is deductions that take place before we pay taxes. So these are things that take place right after the income is earned, before any taxes are taken out of our check. These deductions are actually removed, which I'm going to show you, and that reduces our not only our take-home pay, which is fairly obvious, but also reduces the taxes that we pay. So to give you an example here, first we got to talk about what we call AGI, or adjusted gross income. Now, AGI, if you've ever filed taxes before, you'll notice that what you pay in taxes starts with your adjusted gross income. Now, this is not your gross income or what you earn. So let's say you earn $50,000 a year and various taxes are taken out. Your gross income is $50,000. But for calculating taxes, we use AGI, which incorporates certain deductions. So we can reduce that and thus save us on taxes, which is the benefit. Now, on the right-hand side, this is a very simple tax bracket. This is updated to 2018, and this is for a single filer. And so the U.S., we have a very, what we call progressive tax system. And what that means is, I'm sure you're already kind of gathering that looking at the bracket here, is as we progress down the bracket, as your income increases, the taxes that you pay increase. So on the first $9,525 of income, if you are a single filer, so if you're married, you have a different tax bracket, you're going to pay 10%, or $952.50. On the next amount of money, right, between $9,525 and $38,700, you're going to pay 12%. So as you get higher on, and the brackets continue after 22, but for our example, we're just going to go up to 22%, you're going to pay more in taxes. And so by reducing our adjusted gross income here, we can thus pay less in taxes and maybe fall into a different tax bracket, which is far more advantageous for us. So I know this probably seems a little abstract at this point, so let's walk through an example so you can kind of see how this looks from a practical sense. So let's go ahead and assume that we have $5,000 in monthly taxable income. And so basically we make $60,000 a year. That would essentially be our adjusted gross income, $60,000 a year. So under scenario number one, which is in this second column here, we're not going to contribute anything. We have no pre-tax contribution, so we're not contributing to, let's say, a 401k. As a result, if we have $60,000 in adjusted gross income, we're going to pay 22% on any amount over $38,700, and then obviously 12% and then 10% subsequently. Now, I did the math already just to save us some time, and we would essentially pay a monthly tax liability of $761.63. So essentially what this means is our monthly take-home pay, which we take our $5,000 and we subtract any of our deductions, including taxes, our monthly take-home pay is $4,238.37. That's our monthly take-home pay. Looks pretty good. So let's see what happens when we have a deduction. So this is scenario number two. we're going to keep things consistent, so we still have a monthly taxable income of $5,000. But this time, we are going to contribute $500 every month into our 401k. So we now have a pre-tax contribution. Now, because of this changes our annual adjusted gross income. It now goes from $60,000 in scenario 1 to $54,000 in scenario 2, because $500 multiplied by 12 is $6,000 a year. Subtracted from our $60,000 is $54,000. So that means we're going to pay less in taxes. So I've already done the math, and we would go from paying $761.63 to actually paying $651.63. So now what this means is, instead of a take-home pay of $4,238.37, our take-home pay is now $3,848.37. Now, you're wondering, our take-home pay has decreased, so this is a bad thing, right? Well, not necessarily. Let's look at the difference between these two take-home pays. So I'm going to calculate $4,238.37 and then subtract scenario 2, which is $3,848.37. And that means that our take-home pay decreased by $390, right? So taking the $4,238.37, subtracting the $3,848.37. So this is how much our take-home pay decreased. But if you think about it, our take-home pay only decreased $390, but we increased our contributions by $500. So this is the wonderful thing of pre-tax contributions, is because we are paying less in taxes, the money that we contribute, we actually are able to contribute more and get a little bit of a savings. Instead of normal scenarios where if you contribute to a Roth IRA, we're still contributing $500 and still $500 has no impact on taxes. But by taking the taxes on the front end, by taking the contributions on the front end before taxes are paid, we're essentially freeing up $110. So that $500 tax payment in our 401k or 403b is really only costing us $390. So we're saving $110 basically in free money almost, which is pretty fantastic. And that represents the value of utilizing pre-tax contributions.